People constantly ask me how to get rich, but almost no one is interested in how not to lose money. This is exactly the difference between smart people and merely impatient ones. Those thirsty for success look for shortcuts, while the smart ones strive for survival. I have lived long enough to understand that you don't need to be a genius to build wealth. It is enough just to avoid outright stupidity. Unfortunately, stupidity never goes out of style. People often forget that parting with money is much easier than earning it. All it takes is one wrong decision, a bit of arrogance, a drop of envy, and the result of compound interest that you worked 30 years for evaporates in 30 days. Warren and I have a rule that seems simple, but to us, it is almost sacred. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is not a joke or an advertising slogan. It is a survival code. When I first heard it, it seemed overly cautious to me. But over the years, I realized that this is the only way to stay rich. Let me tell you something about risk. Most people perceive it as a set of numbers, volatility, beta coefficients, charts, and ratios invented by academics who have never missed a mortgage payment. That is not risk. Risk is waking up one morning and realizing that you have destroyed your financial future because you borrowed too much, started speculating too early, or trusted too carelessly. In the 1970s, many smart men went broke chasing easy money. Oil stocks, real estate bubbles, penny stocks that were supposed to be the next big breakthrough. It all ended the same way, in tears and write-offs. It wasn't that they didn't understand the math, it was that they didn't understand themselves. They couldn't overcome the desire to look smart, act without thinking, and chase after what everyone else was chasing. That is exactly how money is lost. Not out of ignorance, but out of ego. If you study history, you will see that this pattern repeats endlessly. In 1929, people thought the stock market could only go up. In 2008, they believed housing prices could only go up. Today, they are certain that technology can only get more expensive. The costumes change, but the stupidity remains the same. The problem is that people don't want slow wealth. They want everything at once. But quick wealth rarely stays for long. The compounding effect works slowly, and patience seems like a boring endeavor. On the other hand, losing money is thrilling and exciting, and it is also final. When we say, never lose money, we don't mean that stocks will never dip in price. We have had plenty of losing positions, but we never bet everything. We never risked total ruin. We never let ego or excitement override the arithmetic, because if you lose half of your capital, earning 50% isn't enough to recover. You need to make 100%. That is the math most people never grasp. So the essence of the game is not to hit home runs. The essence is to stay in the game. Keep your capital intact. Avoid stupidity as if your life depends on it, because it does. The trouble is that avoiding stupidity doesn't look sexy. Nobody throws a party to celebrate, "I didn't go bankrupt this year." But such is the quiet truth of compound interest. It rewards the survivor, not the gambler. Looking back on my life, I see that the biggest returns didn't come from flashes of genius. They came from avoiding disasters, not buying overpriced garbage, not partnering with crooks, and not trusting people who said, "Trust me." If you survive long enough, opportunities will find you. But if you blow up at the start, you simply won't live to see that moment. That is what never lose money really means. It means having discipline when everyone around you is drunk on optimism. It means saying no far more often than yes. It means sitting on cash while everyone else is bragging about their latest stock picks. There is a saying in poker: you don't have to win every hand. The main thing is not to go bust. It's the same in investing. You don't need to be a genius. You just can't afford to be a fool. And believe me, the world is full of fools with prestigious degrees. So, when people ask for my best investing advice, I tell them this: forget about making millions. First, learn not to lose thousands. Do this consistently over a few decades, and you'll be surprised at how rich you become simply by refusing to be stupid. Because in the long run, the market rewards the rational and destroys the reckless. That is rule number 1. And if you truly understand it, you will never need another. If you want to understand why people lose money, don't start with finance textbooks. Start with human nature. The real enemy of wealth is not inflation or taxes, it's emotions. Fear, greed, envy. The holy trinity of financial destruction. Each of them has wiped out more fortunes than any market crash. People don't lose money because they can't do the math. They lose it because they can't control themselves. You can teach a person how to discount cash flows, but you can't teach them not to panic when the ticker turns red. During the Great Depression, I saw grown men cry over falling stock prices, and decades later, I watched their grandchildren repeat the exact same behavior. The human brain did not evolve for rational investing. It evolved for survival. Fight, flight, or follow the herd. Useful in the jungle, but disastrous in the market. Most investors don't even realize they are being emotional. They call it intuition or gut feeling. But in reality, it is a primitive impulse masquerading as insight. Every time there is a boom, optimism becomes a drug. And like all drugs, it feels great until the effects wear off. During the tech bubble of 1999, people quit their jobs to day trade internet stocks that had neither profits nor business models. The madness was so thick, you could feel it in the air. When the crash happened, everyone kept repeating the same thing. No one could have seen this coming. Of course we could. It was obvious to anyone who wasn't intoxicated with greed. And then there's fear, the other side of the same coin. When markets fall, people suddenly want to sell everything. It's like jumping out of an airplane because you don't like turbulence. In 1974, during the oil crisis, stocks were selling for pennies, but nobody wanted them. People wanted safety. Cash, bonds, anything that seemed secure. Meanwhile, true safety lay in buying great businesses at bargain prices. Fear blinded them. This is the psychology of losing money. You buy high because it feels good. You sell low because you're scared. And then you call it bad luck. It's not bad luck. It's bad brain wiring. And envy. Oh, that's the worst of all. People can accept being poor, but they cannot stand being poorer than their neighbor. You see a friend double their money on crypto or meme stocks, and suddenly your own portfolio seems small. So you jump on the bandwagon because you can't bear the thought of being left out. That is exactly how bubbles inflate. One envious fool after another. Envy is a tax that the stupid pay to the smart. And yet, it's the easiest thing to avoid if you have the discipline to stay in your own lane. You see, the market isn't designed to make you rich. It's designed to expose your weaknesses. And most people walk around with open emotional wounds. They think the market is the problem. No, the problem is in the mirror. If you can't calmly watch your stocks drop without losing your mind, you shouldn't own them at all. If you can't resist following the crowd will eventually lead you off a cliff. That is why Warren and I built our system on temperament, not intellect. Temperament is underrated because it's boring. You can't put it in a spreadsheet, but it is exactly what preserves your wealth when the world goes mad. Remember this, the market is a machine designed to transfer money from the impatient to the patient. This isn't poetry, it's arithmetic. The impatient investor trades on emotion. The patient investor acts on logic. One ends up bankrupt, the other gets rich and bored. And boredom, by the way, is one of the greatest advantages you can have. If you can sit quietly while everyone else is panicking, you will soon own their assets. So the next time you get the itch to make a trade, ask yourself, am I making a rational decision, or am I just trying to feel smart, special, or secure? Because behind every financial disaster is usually a perfectly normal person who simply couldn't stand doing nothing. This is how money is lost. Slowly, quietly, emotionally. Not out of ignorance, but out of an inability to sit still. Most people don't lose money chasing risk. They lose it chasing safety. That is the great irony of investing. The more people crave comfort, the more danger they put themselves in. Safety feels good, which is why it sells well. Wall Street knows this. Advertisers know this. Even politicians know this. People want to believe that there is such a thing as guaranteed returns. They want someone to say, "You'll be fine, just trust me." And that phrase, "just trust me," has bankrupted more people than recessions. In my early years, I watched many so-called safe bets collapse. Municipal bonds that defaulted, blue chips that turned into roadkill, real estate that never recovered, and of course, the infamous diversified funds that were neither diversified nor funds worth owning. Just marketing dressed up as prudence. The illusion of safety rests on two pillars: ignorance and comfort. Ignorance, because people think stability equals safety. Comfort, because they prefer a pleasant fairy tale to the harsh truth. A stable price does not mean a safe investment. Ask anyone who owned Lehman Brothers in 2008. Everything looked solid until it wasn't. There is a difference between what feels safe and what actually is safe. Cash feels safe until inflation eats it alive. Bonds feel safe until interest rates start rising. Housing feels safe until the bubble bursts. Everything looks safe when you stop asking questions. This is why most investors are caught off guard. They stop being curious as soon as something looks familiar. I have always said, it's not supposed to be easy. If it were, stupid people would do it and still win. But safety seekers want ease. They want comfort, certainty, reassurance, and the world gladly sells it to them. When interest rates were near zero, people said, "Well, bonds are reliable. Real estate always goes up." Then they borrowed record amounts and bought inflated assets. A few years later, they learned the oldest rule of finance. When everyone feels safe, that is exactly when it gets dangerous. Markets work like nature. They punish complacency and reward vigilance. Take Warren and me. We don't chase safety. We build resilience. That is the difference. Safety assumes that nothing bad will happen. Resilience says, bad things will happen, and I will survive them. We keep cash on hand, not because it yields a great return, but because it buys opportunities when panic sets in. That is true safety, the kind that gives you flexibility when everyone else is trapped. I have seen many investors crippled by their obsession with stability. They refuse to take small, rational risks, and then they get wiped out by one giant, irrational risk. The person who says, "I can't afford to lose anything," usually ends up losing everything. Because to truly avoid losing money, you must accept the fact that some things will go wrong. The key is to make sure they don't go catastrophically wrong. That's the secret. Avoid the fatal blow. The rest is just the noise of life. You don't need perfection. You need endurance. And endurance comes from understanding where fragility hides. It hides in leverage. It hides in dependency. It hides in certainty. The more certain you are that something cannot go wrong, the more likely it is that it already has. When I hear someone say, "This time is different," I mentally tune out, because at that moment, they stopped thinking and started believing. Faith is dangerous in investing. Faith turns risk into a religion. And once something becomes a religion, no amount of data will save you. Here is a truth that few like to admit. If you want to be safe in the long term, you have to be comfortable being uncomfortable in the short term. Holding great businesses through bad times feels awful. Sitting on cash while others brag about their profits feels even worse. But both are safer than chasing illusions. Every major crash, every financial tragedy starts with the same phrase. This time is different. It is never different. True safety is invisible. It is boring. It is built quietly over years of good habits and conservative decisions. It's not in the stocks you bought. It's in your discipline. It's in saying no when everyone else is saying yes. Therefore, if you want to never lose money, stop looking for safety in the market. Start building it within yourself, because no system, no guru, and no government can protect a person who refuses to protect themselves from their own delusions. If you want to see a person go broke quickly, just give them borrowed money and a little confidence, leverage, and ego. That is the perfect recipe for financial disaster. I've spent my whole life watching this destroy smart people. They think that because they are smart, the rules don't apply to them. They forget that math doesn't care how smart you are. Leverage is like a knife. Handled carefully, it's a tool. Handled arrogantly, it's a weapon pointed at your chest. Most investors don't blow up because of bad luck. They blow up because they borrowed money to magnify their returns, forgetting that it also magnifies their mistakes. You cannot control the markets. You can only control your exposure to them. And if you use borrowed money, you're not just exposed to the market. You're standing naked in the middle of a hurricane. Warren and I have never been fans of leverage. People ask, why? It can multiply your profits. Well, so can Russian roulette, until it doesn't. One mistake, one sudden crash is enough for leverage to turn a temporary setback into a permanent disaster. I've said it before. The desire to get rich quick is dangerous. Leverage is simply that same desire, but with a credit line. The funny thing is that most people don't even realize when they are using leverage. They think only margin accounts count, but leverage hides everywhere. A mortgage on a house, a business loan you can't repay if sales drop, a safe portfolio that crumbles when rates rise. You are leveraged anytime your comfort depends on everything staying exactly the same. And that's a bad bet, because the world never stays the same. The problem with overconfidence is that it feels like competence. You make a couple of good moves and start believing you're a genius. You stop second-guessing yourself. You mistake luck for skill. I have seen this countless times. In 1999, every tech investor thought they were the next Buffett. In 2007, real estate brokers quoted Warren's sayings as if they understood them. And then 2008 arrived, and they all learned humility the hard way. Confidence makes you bold. Overconfidence makes you blind. And blindness is what kills you. You stop considering downside scenarios. You stop asking, what if I'm wrong? That is exactly when reality presents its bill. The smartest investors I know spend their lives worrying about what could go wrong. Not because they are pessimists, but because they understand that survival is a prerequisite for success. You can't use compound interest if you're bankrupt. The power of compounding works only for the living, not the overleveraged. Buffett likes to say, we never want to risk what we have and need for what we don't have and don't need. That is the most rational sentence ever spoken about money. But people ignore it every day. They risk their financial freedom for a few extra % in returns. They cannot bear the thought of falling behind. So they borrow, speculate, overextend themselves, and then call it bad timing. No, it's not about timing. It's about temperament. If you need leverage to feel smart, you've already lost. If you can't accept slow, steady progress, you're not an investor. You're just a gambler with a better vocabulary. Every time someone tells me they have a sure thing, I laugh. There are no sure things in markets. There are only sure consequences for arrogance. We've made mistakes too. For example, Dexter Shoe was one of our dumbest deals. We paid with Berkshire stock, thinking we were buying a stable business. Instead, we overpaid for mediocrity. But here is the difference. We didn't use borrowed money. It hurt, but it didn't kill us. Leverage turns mistakes into funerals. That is why Warren and I prefer to look boring. We would rather be known as cautious than bankrupt. People confuse safety with slowness, but slowness is nothing to fear when compound interest is working for you over decades. A tortoise that keeps moving beats a hare that dies in debt. The secret to never losing money is not in chasing opportunities. It is in avoiding disasters. And disaster usually walks through the door wearing the mask of certainty. So when you see the crowd getting bolder, when everyone is talking about easy profits and zero risk, step back. Because in this business, when people feel invincible, that is exactly when they are standing on the edge. Leverage is the sound of footsteps approaching that edge. Overconfidence is the push that sends them over, and the fall always happens faster than they expect. Most people cannot stand boredom. That is why most people never get rich. They need excitement. They want to feel like something is happening. To them, the market is entertainment, not a tool for building wealth. But the truth is, real investing is about as exciting as watching paint dry. And if you're having fun, you're probably doing it wrong. I've said this before. The big money is not made in the buying or the selling. It is made in the waiting. The irony is that waiting feels like nothing is happening, but that nothing is quietly, invisibly, and relentlessly compounding. People hate that feeling. They would rather act, even if it's foolish. because action creates the illusion of control. They can't stand the silence between results, so they fill it with noise, trades, and mistakes. That is exactly how they lose money. Every crash, every blow-up, every tragic story of a smart person turned fool begins with boredom. Someone gets tired of being patient. They decide to make their money work harder, which usually means, I'm about to do something stupid. Look at how we built Berkshire Hathaway. We don't chase trends. We don't try to time the market. We don't fall for pretty stories. We find a few wonderful businesses, buy them at a fair price, and then we do nothing. Years go by. We collect dividends, reinvest them, and just wait. That's it. No drama, no fireworks, no clever forecasts. And it works, because time does all the heavy lifting. Compound interest is like reverse gravity. It pulls wealth upward, but only for those who let it work. Touch it too often, and you will break it. The average investor doesn't understand this. They feel like they're missing out when their portfolio is quiet. They don't realize that the silence is exactly where the magic happens. They chase returns, swap funds, buy the hottest tech stocks, and then wonder why their capital looks like a roller coaster. Meanwhile, the boring investor, the one with discipline, patience, and a simple plan, quietly keeps getting richer. Let me tell you something about boredom. It is not the enemy of success. It is proof that you are on the right track. If your portfolio makes you yawn, congratulations. You have probably built something resilient. Thrills belong in Las Vegas, not in your brokerage account. People say, Charlie, how can you just sit on the same stocks for decades? Easily, because I'm in no rush. Compound interest doesn't reward speed. It rewards consistency. If you think you can outsmart time, you will learn the hard way that time always wins. In 1973, when the markets crashed, we didn't panic. We bought some great businesses, and then we waited. 10 years later, those same businesses had multiplied in value. Not because we were geniuses, but because we didn't interrupt the process. Today, I see young investors acting like traders, chasing daily profits like over-caffeinated squirrels. They call it momentum. I call it suicide by activity. The human brain is wired for stimulation. We confuse motion with progress. That is why brokers love you. They get paid when you act. You get rich when you sit still. Patience is a superpower. Boredom is the tax you pay for greatness. If you can sit quietly while others scream, if you can stay invested while others rotate sectors, if you can let compound interest do its slow work without interrupting it, then you've already beaten 90% of investors. That is the paradox. The hardest thing to do is nothing, because it feels like you're missing out. But the market punishes fidgeting, and every unnecessary move leaks value. Any impulsive trade drains the power of compounding. Yes, boring investing wins. It isn't sexy, and it doesn't make headlines, but it quietly builds empires. When the temptation to act arises, remember, activity looks productive, but intelligently chosen inaction is hidden wealth. The best investors aren't the ones who move fast. They are the ones who know when to sit still. And if that sounds dull to you, it means you've been chasing thrills this whole time, not a fortune. If you think education is expensive, try ignorance. Ignorance is the most costly thing in the world, especially when money is involved. After all, capital without understanding is like gas without brakes. It only ends in one big explosion. I have watched waves of new investors over 70 years. Every generation thinks it's smarter than the last, and each proves otherwise by making the exact same mistakes. They confuse making money with understanding what they're doing. The truth is that easy money teaches the worst lessons. When everything you buy goes up, you don't learn discipline. You learn self-delusion. Look at the events of 2021. People made fortunes trading things they didn't understand. Crypto, SPACs. That wasn't investing. They were playing casino games with better lighting. And the cruel part is that, for a while, it worked. Early wins boost confidence, and confident incompetence is poison. They called it a new era and claimed the old rules no longer applied. I've heard that phrase far too often. Every generation invents a new excuse for stupidity. In 1929, it was radio stocks. In 1969, the Nifty 50. In 1999, the dot-coms. In 2008, housing. The jargon is different, but the story is the same. Everyone thought the laws of economics were suspended, but they weren't. Ignorance makes people believe in magic, and the market punishes belief. One of the most dangerous things in finance is superficial knowledge. An investor who knows just enough to sound smart, but not enough to see their own blind spots. They might quote Buffett and use trendy valuation terms, but they don't understand what it feels like to lose half their portfolio. So when the storm hits, they are in shock. He thought he was a long-term investor until long-term turned into minus 50%. That is exactly when the easy money crowd disappears. They never stick around for long, mistaking a rising tide for genius. And when the tide goes out, they are left standing naked, blaming market manipulation. The ignorant investor always finds someone to blame. The wise man knows that the enemy is himself. It is impossible to be rational in markets you don't understand. You can't make sound decisions about businesses you've never studied. And you certainly can't build wealth by following people on the internet who are dumber than you. Knowledge protects you, not perfectly, but enough to survive. And survival is the whole game. Buffett once said, "Risk comes from not knowing what you're doing." That is the truest sentence in finance. The cure for that risk isn't luck, it's learning. That is why Warren and I constantly read, not for pleasure, but for protection. Every page read is another layer of armor between us and stupidity. You can't eliminate risk completely, but you can reduce the number of ways to die financially. That is what real education does. However, most people don't want to learn. They want shortcuts. They would rather buy a hot tip than a textbook. They would rather chase trends than study principles. They call it hustle. I call it laziness masquerading as ambition. The market loves ignorant money. It feeds on it. For every fool who thinks they have outsmarted the system, there is a patient investor quietly sweeping up the profits they left behind. That is how wealth transfers from the impulsive to the informed. If you want to never lose money, start by paying the small price of education now, so you don't pay the massive price of ignorance later. Because here is what the ignorant never understand. The market does not forgive. It doesn't care about your intentions, your optimism, or your excuses. It simply balances the books, and ignorance always ends up on the losing side of that equation. Easy money feels good in the short term, but it makes you weaker, not stronger. It breeds habits that will destroy you as soon as conditions change. If you made money easily, don't mistake it for genius. Test it. Challenge it. Study why it worked. Because what you don't understand today will bankrupt you tomorrow. In investing, ignorance isn't bliss. It's bankruptcy in slow motion. The market is a machine that pumps wealth from the impatient to the patient. It's not poetry. It's a law of nature. Everything worthwhile in life, knowledge, relationships, and money, compounds. But compound interest only works if you stay in the game. And staying in the game requires patience. The problem is that patience looks like doing nothing, and people hate doing nothing. In today's world, where every screen promises an opportunity, waiting feels like failure. But in reality, it is the highest form of discipline. I have said for decades that to be a great investor, you don't need outstanding intellect. You need a temperament capable of enduring boredom, doubt, and delays. Buffett and I have spent most of our careers waiting for the right price, waiting for the right business, waiting for the rest of the world to start acting irrationally. And when the world finally lost its mind, we were ready. This is the secret nobody wants to hear. Patience is profitable precisely because it is so rare. In 2008, when panic was spreading like wildfire, we weren't selling, we were buying. Not because we are fearless, but because we trained ourselves not to flinch. That is discipline. It's not about being rigid, it's about control. You don't let emotions run the show. You let arithmetic decide. Most investors do the opposite. They buy when they feel good and sell when they feel bad. Discipline is the opposite. You buy when it is rational, not emotional. And most of the time, being rational is terribly uncomfortable. The best behavior does not mean total inaction. It means waiting with intention. You learn, you prepare, you hone your judgment, so that when the opportunity finally appears, you can strike hard and fast. Opportunity is like a rare bird. You don't chase it around all day. You sit quietly and wait for it to land on your shoulder. Then you grab it before it flies away. But you can't do that if you're constantly jumping from one shiny object to the next. The impatient investor always needs to be doing something. The patient investor is perfectly content watching everyone else do the wrong things. Patience is emotional control in disguise. It is the ability to remain rational when the world encourages hysteria. Think of all the great fortunes in history. Not a single one of them was built on speed. They were built on endurance. Our position in Coca-Cola is an exercise in patience. We didn't buy it to flip it. We bought it because we understood the business. Then we waited while others traded around it. Every year, people asked if we were going to sell. Every year, we didn't. And every year, our silence made us richer. That is compound interest. Doesn't care about trends or hype. It only cares about time. But time is merciless to the undisciplined. If you cannot control yourself, the market will do it for you by taking your money. The truth is that wealth is not created in the market. It is built in your mind. The market simply reveals who you are. If you are impatient, it will expose that. If you are greedy, it will exploit that. If you are disciplined, it will reward that. Discipline is not an event. It is a lifestyle. It means saying no more often than yes. It means refusing to follow the herd, even when the herd is laughing at you. Warren and I have been called stubborn, old-fashioned, and out of touch. That's fine. The scoreboard is indifferent to opinions. In the short term, discipline looks boring. In the long term, it looks like genius. People always say they want to invest like Buffett and Munger, and then they check their portfolio every morning. That's not investing. That's anxiety masquerading as activity. You can't utilize compound interest if you constantly interrupt the process. The long game requires something that most people never develop: faith in their own judgment. Not blind faith, but rational faith. The kind built on knowledge, experience, and arithmetic. That is why we read, why we think, why we sit still. Because when the storm comes, you do not rise to the level of your expectations. You fall to the level of your training. Patience and discipline are your training. They are the invisible advantage that no algorithm can copy. So, if you want to never lose money, stop looking for thrills. Just stop. Start developing endurance, because in the long run, the market doesn't reward brilliance. It rewards the survivor. I've seen a lot of smart people go broke, and it didn't happen because they lacked intellect. It happened because they were smart in the wrong direction. Intellect can make you rich, but an unchecked ego will make you stupid. And when you mix intellect with arrogance, you get a financial bomb ready to explode. You might think that being smart protects you from being stupid. It doesn't. It just gives you more inventive ways to justify it. Let me give you some classic examples of the dumbest ways smart people lose money. First, they believe they are the exception. They think the rules apply to everyone else, but not to them. They see how leverage, speculation, and overconfidence destroy others, but somehow conclude that they are immune. Sure, most people lose on options, they say, but I've got it all calculated. Yes, that's exactly what they thought at Long-Term Capital Management, a team of Nobel laureates who managed to lose billions in 1998. The market doesn't care about your IQ. It only cares whether you are disciplined. Second, they mistake complexity for sophistication. Smart people love complexity. It flatters their intellect. They build elaborate models, run simulations, and convince themselves they have eliminated risk. But in reality, they've only hidden it. Complexity is seductive because it feels like control, but usually it's just confusion in disguise. I have always preferred simplicity. If I can't explain a business in one paragraph, I don't want to own it. Warren feels the exact same way. He once said, "There are no extra points for difficulty. Simple ideas, executed consistently, that is how you win." Third, they fall in love with their own ideas. As soon as a smart person forms a thesis, they will defend it like a religion. Facts won't matter. Charts won't matter. Losses won't matter. They are no longer investing. They are worshiping. And when faith replaces reason, the market eventually delivers the sermon. A wise investor doesn't marry a stock, a strategy, or a P&L statement. They only marry the truth. Fourth, they cannot admit their mistakes. Pride has emptied more wallets than recessions. When we make a mistake at Berkshire, we don't hide it. We write about it in plain English for millions to read. That's not virtue. That's practicality. If you don't face reality, reality will face you, with interest. Smart people hate being wrong. They think being wrong means being stupid. But in investing, being wrong is mandatory. Staying wrong is optional. And finally, they chase envy. This is a universal phenomenon. Even intellectuals cannot stand it when someone else gets rich faster. It eats at them. It distorts their judgment. And before they know it, They start buying things they don't understand, just to keep up with people they don't even like. As I've said before, envy is a truly stupid sin, because it is the only sin from which you can't derive any pleasure. It is pure, self-imposed misery, yet it ruins even the brightest minds. They forget that life is not a race. The goal is not to win the fastest, but to avoid losing it all. The irony is that the smarter you are, the more danger you are in, because your brain can rationalize anything. You can justify greed, explain away risk, and convince yourself that you're still being rational. You build mental castles of logic, and then the market quietly kicks the door down. That is why I keep preaching the same boring sermon. Stay humble, stay rational, stay alive. Humility is underrated in finance. It keeps you open to correction. It reminds you that the world doesn't owe you a return. I have met plenty of penniless geniuses, but I have never seen a humble investor slowly go broke. Because humility doesn't mean weakness, it means realism. And realism is the only thing that compounds safely. The smartest thing you can do in investing is not to prove how smart you are, but to admit how little you know. That is the paradox of wisdom. The more you learn, the clearer it becomes how easily everything can go wrong. So when you see a crowd of smart people bragging about their returns, predicting markets, and trading on margin, step aside. They aren't wise. They are just next. Most people think wealth is money. It isn't. It is independence. If you have to wake up every morning wondering what the market did overnight, you are not rich. You are just an anxious person with a brokerage account. True wealth is being able to sleep soundly while the world panics. I've known billionaires who were miserable, terrified to death of losing what they had built. That isn't wealth. It's just slavery with nicer wallpaper. The goal isn't to have more money, but to need less reassurance. Warren and I never wanted to be the richest guys in the graveyard. We wanted freedom, the ability to think and act without being at the mercy of the markets or bankers. That is true safety, and it comes from structure, not luck. You see, most people misunderstand safety. They think it means having a big number in their bank account. But numbers can lie. They go up, they go down, they give you confidence one day and despair the next. Safety isn't external. It is internal. It is a mindset built on rational habits. Spend less than you earn. Invest in what you understand. Avoid debt like radiation. And never depend on a single source of income, a single boss, or a single illusion. Do this for decades, and the world can collapse around you without dragging you down with it. When I was young, I thought money would solve everything. Then I watched people who had far more money than I ever would, and I realized they were often more trapped than the poor. The poor worry about survival. The rich worry about losing status. Both are forms of fear. Freedom begins when you stop playing those games. True wealth is not measured by how much you can buy. It is measured by how little you have to worry. A person who can live below their means, ignore envy, and stay calm during a panic, that person is rich, whether they have 10 million or 10,000. That is why I keep hammering home the idea of not losing money. Because every dollar saved is a piece of freedom preserved. And freedom, once lost, is expensive to buy back. Security doesn't come from a huge salary or picking the right investment. It comes from avoiding stupid mistakes over and over again throughout your life. That is how compound interest really works. not through genius, but through survival. You'll notice the world is full of people chasing financial freedom by copying others, following trends, believing that the next big thing will give them security. They are wrong. Security is not found in motion. It is found in restraint. The less you depend on external conditions, the safer you are. This is just as true in investing as it is in life. If your peace of mind requires a rising market, you're not an investor, you're a hostage. That is why Warren and I structured Berkshire the way we did. No debt that could kill us, plenty of cash to survive a disaster, and a focus on businesses that create real value, not hype. We don't chase what's hot. We protect what endures. When you understand this, you stop trying to be smart. You start trying to be resilient, because ultimately, wealth isn't about beating the market. It's about escaping the trap of dependency. You can't buy peace of mind on the stock exchange. You earn it by being rational, patient, and quietly indestructible. People think security means certainty. It doesn't. Security means resilience. You cannot predict the future, but you can prepare for it. And if you have built your life on solid ground, not on debt, envy, or delusions, then even when the ground shakes, you will still stand. That is true wealth, the kind that cannot be lost in a bear market. Having lived as long as I have, you realize that wealth isn't about genius, luck, or connections. It's about avoiding the obvious mistakes that everyone else keeps making. Great investors don't do extraordinary things. They simply avoid doing stupid things for an extraordinarily long time. That is why I keep repeating it. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It sounds simple, too simple for an ambitious mind. But that is exactly why it works. Complexity attracts ego. Simplicity protects the truth. Most of what I've learned about money, I learned the hard way by watching others destroy their savings. They were smart, educated, and full of confidence. And yet, they couldn't resist the same traps: greed, leverage, envy, and impatience. The human brain never changes. That is why the exact same financial mistakes are repeated in every generation. You cannot beat human nature. You can only outsmart your own. The real battle is not against the market. It is against your impulses, your need to act, to prove yourself, to belong, to feel smart. That is what makes the rule, never lose money, so hard. Because the temptation to break it will never disappear. There will always be a shiny opportunity, a guaranteed return. A friend who made a fortune overnight, and a voice in your head whispering, "Why not you?" That is exactly when you remember the rules. It's not a slogan, it's survival. We built Berkshire Hathaway by saying no 99% of the time. No to speculation. No to things we didn't understand. No to people we didn't trust. If we couldn't explain a deal in plain English, we passed. If it required hope instead of arithmetic, we passed. If it smelled of leverage, we passed. And we still got rich. Slowly. Safely. Surely. Because the goal was never to be flashy. The goal was to endure. Every crash, every recession, every mania we lived through rewarded the exact same virtues: patience, rationality, and humility, and punished the exact same vices: greed, arrogance, and overconfidence. So when I say, never lose money, I don't mean never make mistakes. I mean never let a mistake destroy you. Always maintain a margin of safety. always protect your downside. Always stay in the game. The world doesn't hand out medals to risk takers. It quietly buries them and moves on. But it rewards the survivors. The men and women who can do nothing when nothing needs to be done. Who can think independently. Who can resist the madness of the crowd. Because the truth is, getting rich isn't hard. Staying rich is. You don't need to be a genius to keep your money. You just need to consistently not be stupid. That is the hardest part, because stupidity is always on sale. It comes disguised as an opportunity, dressed up as innovation, and sold by confident idiots. If you can resist it, you will be fine. If you can't, no formula will save you. So, let me leave you with this. The game of investing is not about scoring points. It is about avoiding fatal errors. You don't need to predict the future. You just need to survive the present. Do that for a few decades, and the future will take care of itself. And when people ask you about your secret, you can smile and tell them the exact same thing I've been saying my entire life. It's simple,